Welcome to Griffonomics.
Hey, great to be here for this deep dive.
So I want you to imagine that you start a business tomorrow, and you're manufacturing a simple, boring metal latch.
Okay, like a cabinet latch or something.
Yeah, exactly. Just
Yeah.
a standard latch. Now, in the normal world, if you charge $10 for it, someone down the street will figure out how to make it for $9.
Oh, sure. And then within a year, your profit margins are completely squeezed to nothing.
Right, because that's just the brutal reality of manufacturing,
Yeah.
But imagine a parallel universe where the federal government steps in.
Okay.
And they guarantee that you, and literally only you, are legally allowed to sell that specific latch.
Wow. I mean, that sounds like a complete fantasy, right?
Totally. It sounds like an absolute violation of free market capitalism.
Yeah, but because of that guarantee, you can comfortably charge like a 50% profit margin.
Exactly. And not just for a year, not for a decade, but for the next 40 years.
Which is just insane to think about. But, if you are looking at your portfolio right now and wondering why certain boring, invisible industrial companies are just printing money hand over fist.
While, flashy tech startups burn to the ground.
Right, exactly. This is the exact dynamic you need to understand.
So today we are tearing apart a massive stack of high-level financial filings, investor presentations, and strategic analyses.
We're looking at 4 massive, distinct aerospace giants today. TransDigm, Loar Holdings, HEICO, and Astronics.
And we are not just geeking out over airplane parts here, right?
No, definitely not. We are doing a deep dive into the architecture of extreme economic moats.
And some of the most aggressive, high-stakes capital allocation gambles happening literally anywhere in the market today.
Yeah. And if you are listening to this right now, our mission today is to build you a granular, bulletproof strategic report.
Like a full investment roadmap.
Exactly. We are looking directly at the massive production catalysts hitting the industry right now in 2026.
Because by the end of our conversation, you will understand exactly how to categorize these 4 differing business models in portfolio strategy.
Right. You'll know how to spot the turnaround value plays.
The aggressive growth challenger.
And the core defensive compounders. Because when macroeconomic chaos hits...
And it always does, right?
Inevitably. And when it does, these 4 companies have radically different survival mechanisms.
So to understand those survival mechanisms, we really have to start at the foundation.
Yeah, before we can evaluate their wild financial engineering, we need to understand the underlying physics of their revenue.
Right, like what actually protects the cash flow. Because, going back to my latch analogy,
Okay, yeah.
if I design an amazing new locking mechanism for an overhead bin, what is functionally stopping a giant like Boeing from just taking my design?
And handing the blueprints to a cheap factory overseas.
Exactly, and just cutting me out of the loop entirely.
Well, in traditional manufacturing, absolutely nothing. I mean, Boeing would optimize you out of existence in a heartbeat. But in aerospace, you are dealing with the absolute uncompromising authority of the Federal Aviation Administration.
The FAA.
Right, the FAA. And the regulatory burden they impose creates a phenomenon known as the sole source model.
Sole source, okay.
Yeah, and this is the cornerstone of the first business archetype we need to explore today, which is the proprietary giants.
And in our target group, that encompasses TransDigm and Loar Holdings, right?
Exactly. TransDigm and Loar.
So I hear the term sole source thrown around constantly in defense and aerospace investing circles.
Sure, it's a huge buzzword.
But walk me through the actual granular mechanics of it. What does being a sole source provider actually look like on the factory floor?
Well, it requires looking at the timeline of how an airplane is actually born,
Okay, take me back to the beginning.
When an original equipment manufacturer, an OEM like Boeing or Airbus, is designing a new aircraft, they don't invent every single piece themselves.
Right, that would be impossible.
Yeah, they farm out the microcomponents. Companies like TransDigm or Loar will step in and engineer a highly specific niche component for that exact airframe.
Like what, for example?
It could be a specialized cooling fan for the avionics bay, or a proprietary hydraulic valve.
Or even a specialized interior lashing mechanism.
Exactly, so they invent it. But then comes the gauntlet.
The gauntlet?
Yeah, because they have to get this specific part certified by the FAA and then qualified by the OEM for that specific aircraft model.
And I imagine that certification process is not just a paperwork exercise.
Oh, not at all. It involves brutal physical testing. Thermal extremes, vibration tables,
Wow.
thousands of cycles of stress testing, metallurgical proofs. I mean, it takes years and millions of dollars in engineering hours.
Just to prove that this one tiny valve will not fail at 35,000 feet. It's
Exactly.
like putting a component through a PhD program.
That is a phenomenal way to frame it. You literally hold the PhD for that part.
And the process is grueling, it costs a fortune, and I assume the failure rate is high.
Very high. But once you survive it, you are the only one in the world holding the diploma for that specific screw or valve.
Right. And once that certification is locked in, the switching costs for the OEM become practically insurmountable.
Totally. Imagine Boeing is in the middle of a production run of the 737 MAX.
Okay.
And they decide, they don't like TransDigm's pricing on a hydraulic valve.
They want to cut costs.
Right. But to switch suppliers, Boeing would have to halt production. They'd have to find a new manufacturer.
Wait for them to reverse engineer or invent a new valve.
Put that new valve through years of FAA stress testing. Secure new certifications.
And alter their entire global supply chain just to save, like, $50 on a valve.
Exactly.
Yeah.
It is economically irrational for them to do it. The cost of switching is astronomically higher than the savings on the component.
Wow. So TransDigm and Loar become the sole source for that part on the assembly line.
Right. But here's the real magic trick. They also become the sole source for the aftermarket replacement parts.
For the entire lifespan of that aircraft.
Yes. And commercial aircraft fly for what, 30, 40 years?
Easily, yeah. Sometimes 50 years for cargo conversions.
Right. So for half a century, every single time that valve wears out and needs to be replaced, the airline has a legal obligation to replace it with an FAA-certified part.
And TransDigm is the only company on Earth legally allowed to make it.
Exactly. Because if an airline just decides to machine the part themselves in a back room to save money.
And the plane goes down, the liability is apocalyptic.
Oh, the FAA would ground their entire fleet. The liability makes it completely impossible.
So the proprietary giants essentially have total pricing power.
Total pricing power. The numbers from the filings are just staggering. TransDigm generates approximately 90% of its net sales from these proprietary products.
90%. That's incredible.
Yeah. And Loar Holdings operates the exact same playbook, generating roughly 89% of their revenue from proprietary products.
So because they have a functional monopoly on these micro-components, they can exercise what they politely call value pricing.
Value pricing, yeah. Which is really just Wall Street speak for raising prices until the customer screams but still has to pay.
Right. And it translates into profit margins that completely defy industrial gravity. The deep dive sources show TransDigm is hitting an incredible 52.4% EBITDA margin.
Yeah, let's pause right there to make sure we are translating this clearly for you listening. EBITDA margin.
Right. Earnings before interest, taxes, depreciation, and amortization.
Basically, for every dollar of revenue that comes in the door, after paying for the raw materials, the factory workers, and the immediate operational costs of making the part.
TransDigm is keeping over 52 cents as core operational profit.
Yes, over 50% operational margin on a physical, heavy industry manufactured product.
You usually only see margins like that in software companies,
Right.
where the cost of replicating code is literally zero.
Right, but TransDigm is bending physical metal and achieving software-level economics. They have engineered an industrial business with software economics, insulated by a federal regulatory moat.
It is really a masterpiece of niche capitalism.
It is. However, as lucrative as the proprietary model is, it is not invincible.
Right.
And it is certainly not the only way to build a fortress in aerospace. Which brings us to the second business archetype in our deep dive.
The disruptor.
The disruptor.
And when we talk about disruption in this space, we are talking about HEICO.
Yeah, HEICO is fascinating.
Yeah.
Because they seem to look at TransDigm's 50% margins, look at the struggling airlines paying those prices, and say, well, we can exploit this exact friction point.
And they exploit it brilliantly. The sources detail how HEICO operates what is known as the PMA model.
Right. PMA stands for Parts Manufacturer Approval. Their flight support group, which drives about 70% of their total sales, doesn't bother inventing new parts for new planes.
They aren't trying to get on the assembly line.
No. Instead, they act as highly sophisticated, legally sanctioned cloning operations.
Cloning operations, I love that.
Yeah. They target the most expensive, high-volume replacement parts that companies like TransDigm or the big OEMs sell to the airlines.
So they see an airline crying over the cost of a replacement fuel pump, and HEICO steps in. But How do they actually do it without violating patents or FAA rules?
Through an insanely rigorous reverse engineering process.
Yeah.
HEICO will literally just buy the expensive OEM part.
Okay.
They put it into their labs, they 3D scan it to the micron, they use mass spectrometry and metallurgical analysis to figure out the exact chemical composition of the alloys used.
Wow, so they are literally breaking it down to its atomic structure almost.
Basically, yeah. They determine exactly how it was manufactured, where its failure points are, and what its operational tolerances are.
So they tear the original PhD thesis apart, sentence by sentence, to figure out how it was written.
Yes. And once they have the complete engineering picture, they don't just copy it. They often engineer it to be slightly better or more durable.
Really? So it's an upgraded clone.
Exactly. Then they take their massive pile of data and go straight to the FAA. They prove to the FAA that their newly manufactured part is functionally identical or superior to the original OEM part.
And if the FAA agrees, they issue a PMA, a parts manufacturer approval.
Right. And once they have that PMA, they can walk up to Delta or United and say, hey, you know that valve you've been buying from the OEM for $10,000?
Here is a fully FAA-certified legal equivalent for $6,000.
And the airlines buy it by the truckload.
Yeah.
HEICO currently boasts a catalog of around 20,000 approved PMA parts.
Wait, I have to challenge the logic here for a second.
Sure, go ahead.
We just spent 10 minutes establishing that the FAA certification process is this impenetrable moat that protects TransDigm, right?
Right.
We said it's a grueling, million-dollar, multi-year nightmare. So if the barrier to entry is so high, how on earth has HEICO managed to climb over that wall 20,000 times?
It's a great question.
Why hasn't the sheer weight of the bureaucracy just crushed them?
Because the barrier to entry isn't merely the paperwork, It is institutional trust and scaled engineering infrastructure.
Okay, explain that.
If you or I tried to get a PMA for a single part, the FAA would scrutinize us for years. We have no track record.
Right, they wouldn't trust us at all.
But HEICO has spent decades building a flawless track record with the FAA. The regulatory bodies trust HIO's advanced design engineering. They trust their testing methodologies.
So they have a streamlined process.
Exactly. HEICO has an entire internal bureaucracy designed solely to interface with the FAA's bureaucracy. That institutional grease allows for a significantly faster turnaround time on approvals.
So the moat isn't just the certification itself, it's the relationship with the certifier.
Precisely. For a new competitor trying to, copy HIO and start a rival PMA business, the technical demands and the sheer volume of resources required to build that baseline trust with the FAA create a massive barrier to entry.
So HIO essentially owns the disruptor space.
They do. They function as a pressure release valve for the entire commercial aviation sector.
That makes total sense. When the proprietary giants squeeze too hard on pricing, the airlines just funnel their capital toward HO. It's a beautiful counterbalance.
It really is. Now, this brings us to the third archetype we are analyzing today, which operates on an entirely different plane of existence from the first two.
Right. We have the proprietary giants, we have the disruptor, and now we have the tech leader, Astronics.
Yeah, Astronics is playing a totally different game. They aren't fighting over structural latches or hydraulic valves or cooling fans.
No, they're focused on the passenger experience and the nervous system of the aircraft itself.
Right. Astronics relies on dominant market share in highly specialized, forward-looking technology niches. Their moat isn't built on a 50-year regulatory lock-in for a piece of basic metal.
It's built on technological supremacy.
Exactly. The prime example highlighted in the filings is their ISPS, in-seat power systems.
Ah, right. The actual outlets and USB ports under the seat that keep our laptops and phones alive during a 6-hour flight.
Yes. Astronics holds over 90% of the global market share for those systems.
90%.
Think about the sheer scale of that dominance. They are currently powering over 2 million individual seats across more than 290 airlines worldwide.
90% market share is just absurd.
Huh?
If you plug a device into an airplane seat anywhere on Earth, there is a 9 in 10 chance the electricity is flowing through Astronics hardware.
And that kind of dominance creates its own distinct type of moat.
How so?
Well, if you are an airline outfitting a new multi-billion-dollar fleet, you cannot afford for the passenger power systems to short out or catch fire.
Oh, yeah. The liability and brand damage would be catastrophic. Look at what happens when batteries catch fire on planes.
Exactly. So do you take a chance on a cheaper, unproven electronics supplier to save a few bucks? Or do you go to the company that has safely and flawlessly perfected the system for 90% of the market?
You go with Astronics every single time.
Right.
So we have these three distinct archetypes. But a moat is only as good as the siege it can withstand, right?
Very true.
So let's stress test these models for you listening. What happens when the music stops? Let's say Boeing hits another massive supply chain bottleneck, or there is a crippling labor strike.
Or a quality control crisis that forces the FAA to halt new plane deliveries.
Right. When the OEMs stop pushing new airplanes out of the factory doors, who bleeds and who wins?
That is the ultimate litmus test for aerospace investing, the resilience analysis.
Let's get into it.
When new aircraft deliveries stall, the macro demand for air travel doesn't magically disappear. People still need to fly.
Right, business trips still happen, vacations still happen.
The commercial airlines still have to fly their routes to maintain their gate slots and generate revenue. So if they can't get new planes, what do?
Well, they have to delay retiring their older aircraft, right?
Yep.
They push the aging fleet to keep flying longer than originally planned.
Precisely. And the older an airplane gets, the more it breaks down.
Naturally.
It requires significantly heavier and more frequent MRO, maintenance, repair, and overhaul.
And this aging fleet dynamic is where the business models truly diverge.
Exactly. TransDigm and Loar Holdings are remarkably insulated from an OEM production downturn.
Because even though they lose out on selling their proprietary parts to the Boeing assembly line for new planes,
They more than make up for it because the airlines are suddenly forced to buy a tidal wave of proprietary aftermarket replacement parts to keep the old planes in the sky.
and earlier we established that the aftermarket replacement parts are where TransDigm really flexes its pricing power.
Right. The margins are actually higher when planes break down than when they are built.
That's wild. It's a counter-cyclical hedge built directly into their core operations.
It is. But the company that is the absolute most defensive, the ultimate winner in a macroeconomic downturn is HEICO.
Walk me through the psychology of an airline CEO during a downturn that makes HEICO the ultimate winner.
Well, during an OEM downturn or during a broader economic recession where passenger ticket sales might soften, airlines become desperate.
Desperate to protect their cash flow and profitability.
Exactly. They're forced into these heavy maintenance cycles on old planes, but they are terrified of paying TransDigm's 50% margin prices.
The pressure to cut operational expenses becomes existential at that point.
So they aggressively abandon the expensive original OEM parts and heavily adopt HEICO's PMA parts. HEICO thrives when the industry is financially stressed. They are a utility for survival.
That makes perfect sense. They're the cheaper alternative when money is tight. But what about Astronics? If the planes aren't being built, what happens to the tech leader?
Astronics is highly vulnerable here. Their commercial aerospace revenue is split almost exactly down the middle.
Okay, 50-50.
Roughly 50% from line fit, which means parts installed on brand new planes on the assembly line, and 50% from retrofit, upgrading older planes.
So if Boeing or Airbus delays production, Astronics takes a direct, immediate, and painful hit to half of their commercial revenue stream.
Yeah, they do not possess the recession-resistant, mandatory maintenance insulation of a proprietary aftermarket model.
Right, because nobody has to upgrade the USB ports on a 20-year-old plane to keep it legally flying.
Exactly. You can fly with broken USB ports. You can't fly with a broken hydraulic valve.
Okay, so to summarize our starting grid for you listening before we get into the wild financial engineering.
Let's summarize.
TransDigm and Loar have the monopoly pricing power on specific required parts. AITO has the reverse engineering cost-saving disruptor advantage.
And Astronics has the technological dominance, but they are deeply cyclically tethered to whether or not Boeing and Airbus can actually build planes on time.
That is the fundamental landscape.
Yep, that's the baseline.
Now that we understand their structural moats, we need to look at how these companies are aggressively expanding those moats right now.
In the 2025 and 2026 operating environment.
Because nobody is just resting on their laurels here, the velocity of change is staggering. This brings us to the strategic inflections and M&A, mergers and acquisitions.
Let's start with Loar Holdings. We've mentioned they look like TransDigm, but it's much deeper than that, isn't it?
Yeah, what they are doing is basically financial cloning.
Cloning is the exact right word, and it is entirely intentional. Loar is explicitly replicating the TransDigm playbook.
And it is not a coincidence or like parallel thinking, right?
Not at all. Loar's management team, including their CEO, Dirksen Lehman, previously worked together at a company called McKechnie Aerospace.
And who did they sell McKechnie Aerospace to years ago? TransDigm.
Exactly. They have operated inside the belly of the beast. They know the exact mathematical formula TransDigm uses to acquire companies, strip out inefficiencies, and crank up prices.
So they are taking the TransDigm formula, buying up small, niche, proprietary aerospace parts manufacturers, and executing it on public markets at breakneck speed.
Breakneck speed is right. The filings show Loar has invested over $1.1 billion in M&A since going public.
$1.1 billion. That is a massive deployment of capital for a company their size.
They are scaling with incredible aggression. Let's examine the two massive deals they just closed in late 2025 and early 2026.
Okay, let's break them down.
First, they executed a $474.8 million acquisition of a France-based company called LMB Fans and Motors.
And what does LMB do exactly?
LMB brings a highly protected portfolio of over 2,000 unique, proprietary, high-performance cooling fans and electric motors. These are tailored primarily for military and aerospace applications.
Over 2,000 proprietary designs. That's a huge catalog.
Huge. And then barely a month later, in January 2026, they dropped another $250 million to acquire Harper Engineering.
Harper makes latching and securing mechanisms for aircraft interiors, right? The actual physical mechanisms holding the cabins together.
Yes. That's the area.
Which inherently means they have an exceptionally tight, decades-long collaborative relationship with Boeing.
Exactly. In fact, Loar's CEO specifically noted that Harper has deeply embedded well-established line-fit positions on leading in-production aircraft.
So Loar spends almost $750 million in a matter of weeks. As an investor looking at this, what is the actual operational strategy here? I mean, you can't just buy companies, smash them together, and magically create value out of thin air.
No, the strategy is hyper-aggressive operational accretion.
Okay, let's break down that Wall Street jargon. Operational accretion.
Loar's stated management goal is to take a newly acquired business like Harper, bring it in-house, and literally double its adjusted EBITDA.
Double its core operational profit.
Yes, within a 3 to 5 year time frame.
How do you double a 50-year-old manufacturing company's profit in 36 months? I mean, you can't just fire half the staff. You still have to build the latches.
But you execute two main levers. First, you optimize productivity. You consolidate back-office functions, integrate their supply chains, and basically cut administrative bloat.
Right. Standard private equity stuff.
But the second, much larger lever is achieving what they call value pricing.
Ah, back to the monopoly pricing power.
Exactly. A small, independent, family-run business like Harper might be terrified to raise prices on a titan like Boeing.
Sure, they don't want to rock the boat.
But once Harper is folded into Loar Holdings, Loar acts as a shield. Loar goes to the OEMs and aggressively renegotiates the pricing of those sole source components to reflect their true market value.
Wow. And they just force Boeing to pay up.
Yeah. For both LMB and Harper, Loar's leadership expects these acquisitions to be fully accretive to earnings within 1 year.
Meaning within 12 months, the new profits generated will more than cover the cost of the capital used to buy them.
Exactly. They are targeting full accretion to net income by 2027.
That is a blistering pace of integration. It requires flawless execution.
It does. But while Loar's out there buying traditional industrial latches and cooling fans, EPO is making a strategic pivot that honestly made me stop and reread the filings 3 times.
Yes. You're referring to the Ethos Energy acquisition in Q1 of 2026.
I am.
Let's talk about this, because this is where the narrative gets incredibly strange and honestly brilliant.
It's fascinating.
HEICO is an aviation company. Their entire corporate identity, their entire moat, is built around reverse engineering FAA-approved aircraft parts.
Right.
So why on earth are they buying a company that services industrial gas turbines for the energy sector?
It seems totally disconnected at first glance.
Right. They bought Ethos Energy Accessories, which has massive facilities in Connecticut, South Carolina, and Scotland. What do gas turbines for power plants have to do with airplanes?
Well, if we zoom out and connect this to the macroeconomic landscape, this is a masterful backdoor play on the single biggest macro trend in the global economy right now.
Artificial intelligence and the explosive growth of data centers.
Exactly.
The power grid bottleneck. We hear about this constantly. AI requires so much electricity that we are literally running out of power generation capacity in this country.
Precisely. Training and running exponential large language models requires an absolutely staggering amount of electricity.
And the existing renewable grids and legacy baseload power plants just cannot spin up fast enough to meet the demand of these hyperscale data centers.
Right, so right now, the most viable, immediate solution to localized massive power generation is industrial gas turbines and aeroderivative gas turbines.
Aeroderivative, meaning derived from airplanes.
Yes.
So HEICO's management realizes that a massive gas turbine spinning in a data center power plant to feed NVIDIA GPUs isn't fundamentally that different from a jet engine spinning on the wing of a Boeing 777.
Operationally and metallurgically, the physics and the extreme engineering requirements are nearly identical.
Really?
Oh yeah, the hot section blades, the thermal coatings, the rotational stresses, it is the exact same core science.
Wow.
HEI.A is taking its decades of proprietary expertise in reverse engineering and repairing mission-critical aerospace components, and they're pointing that exact same engineering laser at the energy sector.
That is incredible. And Ethos Energy already has the deep customer relationships, right? They have been servicing the power utilities for decades.
Exactly. HEICO is just stepping in to provide the capital, the reverse engineering scale, and that PMA mindset to completely supercharge and disrupt the energy turbine repair market.
It is genuinely brilliant, taking an incredibly specific core competency and applying it laterally to a totally adjacent, exploding market.
And the sellers of Ethos Energy weren't stupid. They knew exactly what kind of rocket ship they were attaching themselves to.
That is a vital detail in the deep dive filings. The sellers actually demanded HEICO Class A common stock as a significant part of the purchase price.
They didn't just want a cash buyout.
No. HEICO's co-CEO, Eric Mendelsohn, explicitly stated on the earnings call that the sellers recognized how fast this AI power market is growing.
They wanted a piece of the upside.
Right. The sellers viewed the HEICO equity as a sweetener to reward them over the long term because they know how lucrative this pivot is going to be when HEICO applies its operational scale to Ethos Energy's footprint.
And HEICO isn't just playing the AI trend externally as a market opportunity.
Yeah.
The filings show they are actually internalizing AI to streamline their own massive bureaucracy, right?
Yes. On that same earnings call, management confirmed they are actively deploying AI to streamline their own highly complex operations.
Like what, for example?
They gave a specific example of a quality acceptance process, which in aerospace usually requires mountains of physical documents, cross-referencing forms, and manual verification.
Just a bureaucratic nightmare.
Exactly. By applying AI, they vastly improve the efficiency of that workflow. They are also exploring how AI modeling can accelerate their reverse engineering processes and speed up the development of their PMA catalog.
So AIoT is innovating organically and leveraging massive tech trends, while Loar is aggressively buying growth through debt.
Right.
But expanding is great right up until the bill comes due. How are these companies actually paying for all of this aggressive expansion?
This is where we must transition from operational strategy to capital allocation. And we need to talk about the financial engineering involved because the systemic risks here are staggering.
Let's start with the benchmark, TransDigm. We spent the first part of this deep dive marveling at their 50% plus margins and their sole source monopoly. But there is a dark side to the TransDigm model.
The dark side.
It is built on a foundation of massive, sustained leverage. The filings show they currently carry a colossal $30.3 billion debt wall.
$30.3 billion.
It is a defining feature of their corporate structure. They use that immense debt load to fund their aggressive M&A, execute massive share buybacks, and pay out enormous special dividends to their shareholders.
But carrying $30 billion in debt has a brutal carrying cost, right?
Oh, absolutely.
Yeah.
They're paying roughly $1.57 billion in annual interest expense.
Over $1.5 billion every single year just to service the debt. I have to push back here.
Go for it.
You called them a defensive core compounder earlier. How is a company carrying a $30 billion debt wall defensive? That doesn't sound like a moat. That sounds like a financial time bomb.
It does sound scary, I'll admit.
If macroeconomic interest rates tick up a few points and stay there into the 2030s, doesn't this entire 50% margin empire instantly collapse under the weight of its own interest payments?
That is the exact bear thesis against TransDigm, and it is a completely valid fear. But TransDigm's immediate saving grace, their shield against that time bomb, is their hedging strategy.
Okay, explain the hedge.
Through complex financial instruments, they have successfully hedged 75% of that massive debt wall through the year 2029.
Meaning their interest rates are locked in. Even if the Federal Reserve spikes rates tomorrow, TransDigm's payments stay the same.
Correct. For the near term, they are fully protected against interest rate volatility. Their immense operational cash flow easily covers that fixed $1.57 billion interest expense.
But you are absolutely right to look at the horizon, right? What happens in 2030?
Exactly. Eventually, that debt wall has to be refinanced. If global interest rates remain structurally high into the next decade, the cost to refinance that $30 billion will skyrocket.
Directly eating into those beautiful 50% margins.
Right. So they are safe until 2029, but the clock is ticking.
Okay, now compare that to Loar Holdings. We established that Loar is explicitly cloning TransDigm's strategy. How are they handling the debt side of the equation to fund their $724 million spree on LMB and Harper?
They are taking an incredibly high-stakes gamble. To fund those two acquisitions, Loar went to their existing credit agreement and borrowed an incremental $685 million.
Okay, so they took out a massive loan to buy the companies. Standard private equity playbook.
It is, but look closely at the cost of that capital. That single borrowing move effectively tripled their full-year 2026 interest expense.
Tripled it.
Tripled it. Before these acquisitions, their 2025 interest expense was sitting around $25.7 million. That new $685 million debt carries approximately $55 million in incremental floating interest expense.
So overnight, Loar's projected 2026 interest expense jumped to a massive $80 million.
Yes.
Let me try to contextualize this with an analogy for you listening.
Yeah, that would help.
It is like TransDigm is a wealthy homeowner with a giant multi-million-dollar mansion. But they have a fixed-rate mortgage that they locked in years ago at 2%, and their massive salary easily covers the monthly payment. They're comfortable.
Right.
Loar, on the other hand, just went out and took a massive adjustable rate floating loan to buy 2 more expensive rental properties based entirely on the absolute hope that they can force the rental income on those properties to double in the next 3 years.
That is the exact dynamic, and it exposes the razor-thin margin for error.
It's terrifying.
It is. Loar's chief financial officer noted on their calls that they expect the acquisitions to be accretive within a year. But what if they aren't?
Right. What if things go wrong?
If Loar's integration of LMB and Harper falters even slightly, if they can't execute that value pricing smoothly, or if end market demand for military cooling fans drops unexpectedly,
that extra $55 million in carrying cost leaves absolutely zero room for operational missteps.
it is a financial high-wire act without a net. If cash flow dips, that $80 million interest expense will swallow them whole.
High risk, high reward.
Exactly.
Meanwhile, you have Astronics sitting in the corner playing a completely different financial game.
Astronics is a fascinating contrast in capital efficiency. While TransDigm and Loar rely heavily on leveraging debt to force growth, Astronics is incredibly lean and efficient.
Let's look at a metric called Return on Invested Capital, or ROIC.
Right. It basically measures how a company turns the cash it has into actual profit. And the data shows Astronics boasts a staggering 15.8% ROIC.
15.8%. I need context for that. What is the average aerospace industrial company doing?
The industry average ROIC is just 3.3%.
Wow.
Astronics is outperforming the sector average by nearly 5 times. And for further context, TransDigm's ROIC is actually a negative 5.9%.
Wait, TransDigm has a negative ROIC. How is that possible with 50% profit margins?
Because the ROIC formula accounts for the total capital invested in the business, which includes that massive $30 billion debt load and the inflated goodwill from all their expensive acquisitions.
I see.
Their capital base is so heavily bloated by debt that their return on that specific metric looks terrible, even though their raw cash flow generation is immense.
Okay, that makes sense.
Astronics, conversely, achieves its returns through raw operational efficiency and organic technological innovation.
The filings specifically highlight a masterstroke by Astronics management issuing 0% convertible notes to manage their capital needs without burying themselves in crippling interest expense.
Exactly.
So Astronics doesn't have the monopolistic pricing power of TransDigm, but they are wildly, incredibly efficient with every single dollar they spend.
They are.
Which naturally asks the question, if they aren't squeezing airlines on replacement valves, how exactly are they generating this hyper-efficient growth?
They are playing the content per plane game.
Content per plane.
The strategy is to embed as much of their proprietary technology into every single new airframe as physically and electronically possible.
Let's look at the commercial side of this strategy first. The filings give highly specific numbers regarding the new Boeing 777X wide-body aircraft.
The numbers are remarkable. On a new 777 or 777X, Astronics expects to install approximately $325,000 in baseline hardware.
And what does that include?
This includes passenger service units, advanced LED lighting systems, and structural fuel access doors.
Okay.
But then, on top of that baseline hardware, they anticipate an additional $350,000 in what is called buyer-furnished IFEC content.
IFEC being in-flight entertainment and connectivity, the screens, the Wi-Fi routers, the data servers on the plane.
Right. So when you combine the hardware and the IVC, Astronics is capturing $675,000 of revenue on every single Boeing 77X that rolls off the assembly line.
$675,000 per plane. That is incredible. The average passenger walks onto a commercial plane and just sees seats, windows, and overhead bins.
Right, they have no idea.
They have no idea that there is nearly $750,000 of invisible Astronics technology hidden behind the composite walls, running under the floorboards, and woven into the data routing systems.
They're effectively turning the modern aircraft into a flying, high-density data and power grid.
And that's just the commercial aviation side. What is truly fascinating about Astronics is their defense masterstroke.
Oh, the FLRAA program.
Yes. The U.S. Army is currently developing the Future Long-Range Assault Aircraft, known as the FLRAA program. Specifically, this is the Bell V-280 Valor.
For you listening, this is the highly advanced tiltrotor aircraft chosen to officially replace the legendary Black Hawk helicopter.
Right. It is a massive generational shift in military aviation capabilities.
Exactly. It flies twice as fast and twice as far as a Black Hawk. And Astronics was selected by the military contractors to provide the flight-critical electrical power distribution system for this entire platform.
That's a huge win.
They are currently executing a massive $100 million development effort that runs through mid-2027 to engineer this system.
$100 million just in the R&D and development phase. What is the actual payoff for Astronics when the Army finally greenlights full volume production of these tiltrotors?
The payoff is a targeted $1 million in shipset content per aircraft.
$1 million per aircraft.
Every single time the U.S. Army buys a new FLRAA tiltrotor over the next several decades, Astronics secures $1 million in revenue.
Wow. So Astronics is literally banking on the future volume of these next-generation platforms.
They are.
Which brings this entire strategic conversation to a head. We have examined the moats, the M&A velocity, the staggering debt loads, and the technological innovation.
But none of these companies exist in a vacuum.
Exactly. All of these strategies are currently colliding with real-world macroeconomic forces right now in 2026. Let's look at the catalyst watch.
The single biggest macroeconomic force acting on this sector is the commercial build rate. We refer to this as the rising tide.
Okay, the rising tide.
Over the next 2 years, the duopoly has laid out massive production targets. Airbus plans to produce approximately 1,900 aircraft, and Boeing plans to produce around 1,300 aircraft.
So 3,200 planes total.
Yes. This represents roughly a 15% compound annual growth rate, or CUGR, over 2025 production levels.
A 15% jump in production. That is a massive volume increase. That is 3,200 new planes entering the global fleet that desperately need in-seat power, LED lighting, and data systems.
Right.
That is the ultimate tailwind for Astronics, right?
It is the ultimate tailwind, but it is also their most glaring Achilles heel.
How so?
This production ramp is highly fragile. The global aerospace sector is still battling severe systemic supply chain constraints.
Oh, sure.
There are persistent raw material shortages, specifically regarding aerospace-grade titanium, and intense, localized, skilled labor limitations at both Boeing and Airbus facilities.
Right. We see the headlines about Boeing's quality control issues and delivery delays constantly.
If Boeing or Airbus fail to hit those 1,300 or 1,900 delivery targets, Astronics' revenue projections instantly suffer.
Because they can't sell their parts if the planes aren't being built.
Their $675,000 per plane content strategy is completely neutralized if the planes are sitting half-finished on a tarmac in Seattle because they are missing a rudder.
Right. Astronics is fully leveraged to the OEM's operational ability to actually build the planes on time.
Meanwhile, as we established earlier, if the build rates falter and the new planes are delayed, TransDigm, Loar, and HEI.A just shrug, pop champagne, and keep selling high-margin aftermarket parts to the desperate airlines trying to keep their 25-year-old planes in the sky.
Exactly. The vulnerability is entirely asymmetric. Now, shifting from commercial to the defense side, the macro environment is decidedly grim, which ironically provides a massive growth catalyst for this sector.
It does. Rising geopolitical tensions, ongoing protracted conflicts involving Ukraine and Russia, and increasingly aggressive strategic posturing regarding China are forcing a massive global increase in military readiness budgets.
The strategic sources mention a proposed $1.5 trillion military budget, leading to expected mid-single-digit growth in defense spending across the entire sector.
And this macro catalyst connects directly back to the aggressive strategies we discussed. Loar's $474 million acquisition of LMB fans is highly relevant here, as LMB's core competency is high-performance cooling fans for military and defense applications.
And of course, Astronics is perfectly positioned with their $1 million per plane FLRAA contract.
Exactly. In a volatile commercial market, secured defense spending provides a robust, non-cyclical floor to their revenues.
So we have mapped the entire battlefield. We understand the proprietary sole source moats, the PMA disruptor model, the massive debt strategies, and the 2026 macroeconomic catalysts.
We've covered a lot of ground.
Now, the most important question for you listening, trying to make sense of this for your own portfolio, how do you actually categorize these stocks?
Right, because Wall Street is looking at all these wildly differing models, the high debt, the high margins, the capital efficiency, and they're pricing them very, very differently.
The valuation divergence is perhaps the most telling part of this entire analysis, because it reveals exactly what the broader market values most, which is certainty.
Certainty above all else. Let's look at Astronics again. We established they have an incredibly lean, efficient business with a 15.8% ROIC. They innovate, they secure massive content per plane.
Yet the market is extremely hesitant to give them a premium valuation.
Astronics currently trades at a 2.92x price-to-sales multiple. Now compare that to TransDigm, which commands a massive premium 7.15x price-to-sales multiple.
I need you to explain the psychology behind that gap. If Astronics is so much more capital efficient and TransDigm is lugging around a terrifying $30 billion debt wall, why does Wall Street refuse to pay a premium for Astronics?
It's a great question.
Why do they reward the debt-heavy monopoly?
Because Wall Street will always pay a massive premium for the recession-resistant insulation of proprietary MRO models. They pay for the guarantee of cash flow.
Okay, that makes sense.
Astronics is targeting high teens operating margins, which is solid, healthy industrial growth. But they are hypersensitive to the cyclical whims and operational failures of Boeing and Airbus.
If Boeing misses a delivery target due to a machinist strike, Astronics misses its quarterly earnings.
Exactly. The market hates uncertainty above all else. Now compare Astronics' high teens margins to Loar Holdings, which just upwardly revised its 2026 guidance to between $253 million and $258 million in adjusted EBITDA.
Explicitly targeting a 40% margin.
And TransDigm, as we know, is operating at 52.4%. The market will always punish cyclical OEM sensitivity, and it will always richly reward the structural regulatory monopolies of aftermarket replacement parts.
Even if the capital efficiency, the ROIC, is technically much lower due to massive leverage.
Exactly.
So if you are structuring a portfolio today based on everything we have unpacked over the last hour, how do we systematically categorize these four distinct companies?
Let's give you the final verdict and the investment roadmap.
Based on the structural moats and the capital allocation strategies, we can break them into three distinct portfolio buckets.
First, we have the core compounders. This bucket holds HEICO and TransDigm.
HEICO is the ultimate defensive cash flow machine. They protect your portfolio in a macroeconomic downturn by acting as a vital cost-saving utility for stressed airlines.
And TransDigm is the high-leverage benchmark. As long as global interest rates don't unexpectedly shatter their hedged debt wall in the 2030s, their 50% proprietary margins will continue to compound immense wealth.
Okay, bucket two, the riskier play.
Second, we have the aggressive growth challenger. That is Loar Holdings. This is your high-risk, high-reward PE-style play in the public markets.
If Loar management survives the crushing weight of their new $80 million interest expense and successfully executes their value pricing playbook to integrate LMB and Harper and double their EBITDA.
The stock will compound massively, but they have absolutely zero margin for error.
And finally, bucket three, the tech play.
The turnaround value play. Astronics. They are incredibly capital efficient, they are a highly innovative technological leader dominating their niche, and they are currently trading at a massive discount, relative to the sector.
They're essentially a coiled spring, just waiting for the Boeing and Airbus production dams to break.
If the titanium and labor supply chain constraints ease, and the commercial build rate successfully hits that 15% growth target, Astronics will see explosive outsized upside.
It is truly incredible how four massive companies operating in the exact same aerospace industry can have such radically different, highly engineered approaches to survival, capital allocation, and growth.
It is a masterclass in market dynamics. But before we wrap up this deep dive, I want to leave you listening with a final, slightly provocative thought to mull over. A long-term existential question.
Oh, I like those. Lay it on me.
We have spent this entire deep dive analyzing the impregnable regulatory moats of FAA certification, the proprietary dominance of TransDigm and Loar, and the meticulous reverse engineering mastery of HEICO. But what happens if fundamental technology suddenly leaps completely over the regulatory wall?
What do you mean, like a new type of plane?
No, a new type of manufacturing. What happens if the convergence of advanced 3D metal printing and AI-driven instantaneous reverse engineering becomes so incredibly advanced, so perfectly precise, and so cheap that airlines no longer need to call HEICO or TransDigm to replace a broken valve?
Oh, wow. You were talking about completely decentralizing the aerospace supply chain.
Imagine a future, maybe 10 or 15 years from now, where a Delta airline mechanic in Atlanta is staring at a broken structural latch on a 737.
Okay.
Instead of ordering a $5,000 replacement from TransDigm and waiting 3 days for shipping, they just load a certified schematic into an advanced FAA-approved additive manufacturing printer sitting right there in the hangar.
And they print a perfectly spaced, metallurgically flawless, legal titanium latch in 20 minutes.
If the means of production decentralized directly to the airlines themselves, the ultimate proprietary mode of the aerospace aftermarket might just be an illusion of our current technological era.
That is a terrifying thought for any executive currently managing a $30 billion debt wall based on 50-year monopolies. It forces you to rethink the entire timeline of these moats. Risk defined, portfolio protected.